Those things.
But they count. All of those things count toward moving you into the brackets and moving you into taxable income. But the actual tax computation at the very end, what we're basically doing is just chopping that off and taxing it at 0, or taxing it at 10, or at 15, and or at 20. And then there's another tax that's due to the Affordable Care Act that you're going to be laying on top of that, but I'll talk about that later. Yeah.
So, clarification, does your capital gain or dividends come into your income that goes to part of your taxable income?
Yes, it counts. It still counts as income. It's just it's taxed at this special rate. Okay. So a couple of things about, I wanted to talk to you just a little bit about charitable giving, because I think everybody, I'll just say it right now, everybody should give to charity. I mean, you ought to figure out one cause or another, and I'm sure many of you feel that way, to make the world a better place. So I just want to throw in a couple of things to help you along those lines. First of all, if you give more than $250 to a charity in a given year, you write a check for more than $250, you must get a letter from that charity acknowledging your gift. And not only that, saying that the gift was fully received by the charity and that you did not receive anything in return. Or if you did receive something in return, like if you gave to KQED or something like that, that's also specified in that letter. You know, you got a copy of a book by so-and-so, and that book was worth $20. So if you gave them $200, now you only have a deduction of $180 for that particular item. Out-of-pocket costs when you're helping out in a charity also can be deducted. And mileage can be deducted at 14 cents a mile. So, you know, maybe what you're doing is you're transporting some kids to kids around a camp or something like that, and so that mileage, you know, that you have there will be deductible at 14 cents per mile. A little bit later on in your lives, as you develop some appreciated assets, as you invest and have some money that has grown, you've got some stocks that have done very well. Perhaps some of you even now might have some Google stock or Facebook or something like that. Always, if you can, give appreciated stock to your charity rather than cash. And the reason for that is because when you give appreciated stock, it's treated just like cash, and you're not having to pay the capital gain that you otherwise would have had to pay on that appreciated stock. So that's something that you should definitely consider. Moving on to year-end tax planning. The time to effectively plan for your tax is between now and December 31st for 2017. Don't wait until you have to drag your papers to some accountant in February of next year, because that's not going to help. The die will already have been cast. As I said earlier, it's nice to be able, if you can, to spread out your income. Let's suppose that you have a very large spike in your income. And maybe it's because of your company's stock got bought out, and now so you have a very, very large amount of income that may be subject to some tax. What can you do to bring otherwise those taxes down a bit? You could think about donations, deductions that you otherwise would have taken in a future year or 2 or 3. You might want to accelerate those deductions into the current year. Again, maybe you donate to charity and you give a few dollars to charity every year, so maybe you might want to make 2 or 3 years worth of deductions to that charity this year rather than waiting. Maybe you want to look at the California state income tax that might be due on this money, and you might want to pay that before the end of the year if that would save you money. You have to do some calculations to see whether that would work for you or not. One interesting thing in the charitable domain is something called a donor-advised fund. And so what you can do, again, let's say you made it big. You've got congratulations, say $200,000 bonus or something has happened to trigger a $200,000 income event, and you're thinking, okay, I would like to set aside, I might be able to set aside 4 or 5 years of my charitable deduction budget. Maybe I would like to set aside money, but I don't want to do it all at once. I don't want to give a charity all this money now because they'll think that I'm really, really hot and that I'm going to give it to them every year. And besides that, I lose control of my money and vis-a-vis that particular charity. Once it's in, right? So you can give money instead to what's called a donor advised fund. Many of the brokerage houses have it, Schwab has it, Fidelity has it, and others. And what you do is by giving the money to this donor advised fund, you get a tax deduction for it immediately in that year. And then over a period of time, you can call up the fund and say, hi, I would like you now to give money to Sierra Club or whatever other charity that you want. You can dictate to them what charities you would like to support and how much money of your money can now be applied to. You do not get a second deduction, but what you've done here is you've managed to create a very large charitable deduction in a year when you needed it, as opposed to waiting to some year in the future. So you might think about something like that as part of your year-end tax planning. And again, always make sure that taxes are paid.